Hello everyone, my name is Michael Lamott. I am the founder of ChartYourTrade.com. Our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And one of the things that we all need to know how to do in order to take advantage of the stock market is to be able to understand the overall health of the market. Is the market moving up, down, sideways? Is it getting into trouble? Is the trend about to change? And the market gives us little subtle nuances if we're able to tune in and pay attention and listen to what the market is telling us. If we are able to understand and listen to the story that the market is telling us, then we're able to see where the next steps are and where things are heading and prepare ourselves for the next turn. Whether it is the next upturn, downturn, or if things are getting ready to be a little bit choppy, we could see all these things by understanding market health. So in today's video, I want to talk to you about the behavior of price action around moving averages and how that is something that is a key in determining the overall health of the market. One of the ways that we do that is by looking at different moving averages on different time frames. So on a daily chart, first we'll look at shorter term time frame. So going all the way from a 5-day exponential moving average to a 10-day to a 21-day to the 50-day simple moving average, and then the 200-day moving average. We'll take a look at all those, take a look at why those are important, why we want to be paying attention to them, and how they will help you have a much better understanding of where market health is right now. We're also going to look at these moving averages on different time frames. So we'll take a look at first the daily chart, then we want to look at weekly charts, and we also want to look at monthly charts as well, because all of these different time frames are going to give us clues into what the market is doing and why it's acting the way that it's acting. So let's take a look at some charts. Okay, so for the sake of this video, I just want to focus on moving averages. There's a lot of things that go into the overall health of the market. There's a lot of things going on in the charts that we'll be looking at, but for just this video, we're only focusing on moving averages. So that said, let's dive in. Okay, so on this chart here, first we're looking at a chart of the S&P 500, and up here we're taking a look at the daily chart of the S&P 500, and down here we have the weekly chart of the S&P 500. And we have a couple of different moving averages. Let's zoom in a bit. So this line right here is, let's pull that back up. Okay, so this line right here, that's the 5-day exponential moving average. Then that green line is a 10-day exponential moving average. Below that, this purple line is a 21-day exponential moving average. This red line is the 50-day simple moving average. And this black line down there, that's the 200-day simple moving average. Now, the reason why I look at simple moving averages for the 50 and the 200 instead of looking at exponentials is because those are the ones that the major institutions look at. It's what we've seen throughout our research and market history, what we've seen in other market wizards that have all analyzed the market. Everybody looks at the 50-day simple moving average, not the exponential moving average. That's the one that the institutions tend to use, and therefore that's what we want to use as well, because those are going to be the most reliable when it comes to identifying areas of potential support or resistance. And so that's why we're looking at simple moving averages for the 50 and for the 200-day. And the only real difference between a simple moving average versus an exponential moving average is that the exponential moving averages are going to weigh the more recent day-to-day price action or week-to-week, well, depending on what kind of a chart we're looking at. The difference is that the more recent days or weeks are going to be weighted heavier than the ones that were earlier. In a simple moving average, everything's weighted exactly the same. So anyway, back to this. So we have all these different moving averages, and the reason why each of them are important to consider is because the more time that the price action stays above a certain level, then it becomes due or overdue for a pullback to that level or shakeout below it. And it also shows the strength of the move. So if we are above, say, the 5-day exponential moving average and the price is getting support at that level, then that's a sign of an extremely strong momentum in that index. And for example, like over here, right, from September 29th, really getting support at or around that level, closing above it for maybe about half a month so far. Then finally starting to shake out below the 5-day, shook out below it there, but closed above it, still rallying. It was kind of getting support at that 5-day exponential moving average as well as the 10-day exponential moving average. They were kind of close there, so proximity of moving averages is something else that we want to be aware of as well, because there's traders and investors and so many different market practitioners that are looking at markets in different ways. Some of them are on longer time frames than others, and everybody's playing at different things. So when you have multiple time frames converging at the same point, then it's going to be a lot more eyeballs on that point, and that's why you sometimes get these explosive moves. And you end up seeing that in both the price action as well as the volume action, the volume being down here. So when the S&P 500 finally shook out below the 5-day and the 10-day, rallied back above them and approached the 21-day exponential moving average, you have all these people that are looking at that, and you have even more people that are looking at the pullback to the 21-day exponential, and they pile in. And so when you see a move like this where it's bouncing off of the moving average, so to speak, so like you see that it ran down to it and then it rallied, so that's what a bounce is. It's signifying that there's a lot of support at that level. A lot of buyers are coming in. That's why you see this huge spike in volume. Now, over the past couple of days, the market has continued to consolidate. The S&P 500. Did we undercut the other day? So 25.43.60. I'm looking at that right over here. So 25.43.60 versus 25.44.40. So yes, it did undercut very, very slightly, and that's why you often hear me say that support isn't an exact level, it's more of a zone, right? So we need to think about exact points, but we also need to think of it. We need to simultaneously have the idea that support isn't just a hard line in the sand, that it's going to be a little bit of a range, and so it's within the range there, rallying back above that 25.43 level. I'd go so far as to say probably 25.40, just because that's the next round number that we should be looking at. And it's just kind of trading around sideways. It rallied, it closed in the upper half of the range on that day, and it's getting support at around that level. And what it's doing, when you see markets or stocks or anything really start to chop around it and trade sideways, especially in a strong uptrend like we're in right now, what it's doing is allowing the longer term moving averages to play catch up and get to those levels. So that way you see more of the longer term players getting ready to get in at those levels, or some kind of a move happen at those levels. You're not always going to see rallies. Every bull market eventually dies and rolls over, and eventually there's a bear market. It happens all the time. But what we need to look at and really understand is that when these uptrends can last for a very, very long time. And so when you're seeing this kind of a choppiness and the consolidation and these moving averages catch up when you are in a bull market, then that's something that you want to test, because these bull markets can last far longer than anybody can predict, right? We've heard all over the media, different traders, people are waiting for this thing to just roll over and die, but it hasn't. And I think that part of it, and not to get too far off topic, is because there's so many people that just are saying that, oh, this bull market is long overdue for a pullback and a correction and a bear market. Well, if everybody's waiting for it, then it's less likely to happen, because, well, everybody's anticipating it and the market is going to fool the masses. But the market is also telling us a story, and it's telling us what people are actually doing, not just what they're saying. And everybody's waiting for this pullback, that's what they're saying, but what people are actually doing is when they see any kind of a pullback like this over here, like that over there, they're immediately stepping up and buying. So that's what we want to do, and that's why we want to pay attention to what's going on around these moving averages. So that's a little bit of what we're seeing on this daily chart here. If we go back further and we see the price action and we see a little bit of choppiness here, and then back in August we get this dip below the 50-day moving average. Volume was slightly above average, but it was the first time that we had closed below the 50-day moving average in a little while, in about a month, a little over a month. And then we started to rally back above, and we're getting all this kind of choppy action, right? So when you see this kind of choppy action around moving averages, then that's telling us that the market is still trying to decide which way it's going to go, and that we should expect a little bit of choppiness in the immediate term. But then when we finally see the price action start to climb back above the moving average, and we see the moving averages, the shorter term moving averages, layered on top of the lower term moving averages, then that's something that's saying that, okay, this trend is starting to get a little bit stronger and go in the direction either higher or lower. And so like, take a look over here, right? If we take a look at, say, zoom in this way, and some of these moving averages, well, when you see them start to get commingled, and one is the shorter term is below the higher term, and then like you have some other like over here you have the 5-day exponential moving average crossing below the 10-day, but it's still above the 21-day. Now it's starting to go below the 21-day, but the 10-day is still above it, and then you just have them all kind of tied up and knotted. That's when you're going to get this kind of choppiness. So pay attention to knots in moving averages. When they're all layered on top of each other or below each other in the downtrend, that's when you're going to get more of these smoother trends. So be mindful of these knots. And when you have them layered on top of each other, like we do right now, that's when you're having these stronger trends. So right now, where is the 5-day exponential? The 5-day is at 2,563, and the 10-day is at 2,560. So they're starting to converge a little bit as the long-term moving averages are playing catch-up, but they're not all knotted up in a bunch just yet. If that happens, then I would look for additional choppiness, kind of like what we saw back in August. Let's take a look at some of these moving averages on the weekly chart. So pop up the weekly chart by itself. Let's change this to the 10-week moving average. And we have the 40 line. The reason why we're looking at the 10-week and the 40 is because they're basically mirror images of the 50-day moving average and the 200-day moving average that we saw on the daily chart. The difference is really just in the math. So we're looking at 10 weeks of action versus 50 days of action, and so it'll be slightly different where we're looking at the closing prices on weekly basis versus daily basis, and same thing for the 40-week moving average. But it's really the same idea. And so the 10-week line is important because that too is where institutions typically step in and buy. And I'm talking about the big institutions too, like the hedge funds, the major mutual funds, the pension funds, your 401k. Those are the ones that are stepping in with the billions of dollars and are buying at that longer term moving average, and also the 40-week line as well. And the reason why they tend to use those longer term are because they're longer term in nature. It takes them an extremely long time to accumulate a position with billions of dollars at their disposal. So that's really the logical reason why they're using the 10-week and the 40-week. So we want to pay attention to them as well, because that's where in these kinds of uptrends where we could get really good deals, right? If the price action is right, and some of those other things that's a little out of the scope of this video, but like over here, for example. So we see this nice smooth uptrend holding the 10-week line. Then we see this spike below the 10-week line right there, right? So on a closing basis, it closed below the 10-week line, and the character is slightly different than what it had been leading up to that point. You see that it was kind of getting tighter and tighter, more controlled price action, and then all of a sudden there's this spike down, an outside reversal week. So just to give you a little bit of a definition of stock talk, if you will, an outside reversal just means that it's outside of the price action of the week prior, right? So this bar here is completely outside that bar there, and it was a reversal, so it started at the top and it closed near the bottom. So outside reversal towards a bearish outside reversal. You could have a bullish outside reversal as well if it closed at the top. So this was a bearish outside reversal. So here's another week closing below the moving average. So you're not buying the moment that it reverses. You want to make sure that the price action is starting to come back around. You finally see that on this week here towards the end of August, and that's your confirmation that, okay, things are resuming back to the upside here. And you're getting support at the 10-week line, and you caught it there, and now it's well above the 10-week line, and we're starting to chop around a little bit, and you just simply need this 10-week line to play catch up. you're well above this 40-week line. You haven't even touched the 40-week line since November of last year. And so that's why when you're looking at your really long-term accounts, your retirement accounts, that's why it's important to consider the 40-week line and to also really consider monthly charts. And even if you're trading on a shorter term time frame, so if you're an intermediate term trader, swing trading, or even if you're shorter term than that, like if you're a day trader, you want to be cognizant of all the different time frames, because that's where you're going to get the most powerful moves. When you start to see all these different time frames converge into one spot, then you're going to get real powerful moves, because then there's so many eyeballs just fixated on that level. That's where you get this giant blast off in volume, right? So let's take a look at a monthly chart too. So on the monthly, that's where I like to look at the 12-month moving average, simple moving average. All right, so now the red line is a 12-month moving average. And one of the ways that I now like to trade my own 403B account, so in my day job, I work for a not-for-profit, and so in that kind of a world, we're given a 403B. It's very similar to a 401k, and what we end up getting is really a basket of mutual funds from TIAA, CREF, and from Vanguard, and they all basically move in the same direction as the S&P 500, NASDAQ, all these major indexes to one standard deviation or another. But so the way that I manage that is to look at what the market is doing and to manage those mutual funds based off of what the market is doing. So if we are above the 12-month moving average on a closing basis, then I want to be long the market. If we are below the 12-month moving average on a closing basis, then I want to be out of the market. And by out of it, I don't mean that I'm cashing in my retirement and I'm putting it into a mattress. I'm taking it and I'm moving it into the money market fund, so that way when the uptrend does resume, that cash can be immediately deployed back into one of the mutual funds that they offer, but at a dramatically lower price. So what that does is, looking at this monthly chart, you would end up exiting, let me see, did it close below it over here? 1476. It was right on the cusp of closing below it on that month there. It did close below it on this month here, January of 2008, right? So from that point, you're missing this entire drawdown here, and you're getting in back in July of 2009, just when the market started to rally again. So let's just measure what you end up missing. You end up avoiding a 27% drawdown in your account. And not only that, you get to redeploy all that capital at 20%, at a 27% discount than what you would have before. That's the power of moving averages and being able to act in this way. Yes, the drawback of this particular strategy is that you do get chopped up a little bit in an environment like 2011. So you would exit here and you would have entered a little bit higher, all right? But to me, that's worth it to avoid this, and then you're back in for the duration, right? Really until 2015, and then you start to get a little bit choppy, and then you're back in at 2016. So anyway, that's really it on moving averages. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all on anything that I said, please leave it in the comments section below and I will personally answer you. Also, if you like the video, please click that little like button in the bottom of the video and let us know that you liked it. And also subscribe to our channel so that way you make sure that you get all of our updates. Thanks again for watching. I truly appreciate your attention, and if there's anything at all that I could do to help you on your journey in this trading, please let me know. Thank you, and have a great rest of your day. See you next time.